Hello, everyone. Mike Wisniewski and Greg Kuda here. This is Lumber Futures from the Free Seats. This is actually a recorded version. We're starting about half an hour earlier, so it's 11:30 Chicago time right now. Greg had to get off to something at noon, so we're going to get this recorded and then play it for you. So some of the material may potentially be a little dated. That being said, big news this week coming out of the CME. So, Greg, why don't you bring us up to speed on what happened at the CME this week?
Hello, everybody. So the big news coming out of the CME is, from a regulatory standpoint, they had to do something to kind of rectify these continuous limit up, limit down moves. I think we're somewhere in the neighborhood of 25 or 27 out of the last 33 sessions. I literally stopped counting of limit type moves, whether you're closing limit up, limit down, or touching limit on an intraday basis. It's something obscene, the number of limit up moves here. So let me jump forward, Mike.
We got to share your screen again.
Oh, okay. Hang on one second here.
Yeah, I mean, the purpose of the futures markets is for price discovery. So
yeah, and so I'll jump forward to.
You got to get to your next screen. You shared the wrong screen there.
Oh, I'm sorry. Here, let's see.
Yeah, so if you're not having price discovery, the futures aren't working properly.
Yeah. So we touched on this last week. Can you see this now, Mike? So the first step is you raise margins, and they did it twice in less than a week. Here's the first margin increase, the second margin increase. Unfortunately, this just, in a market like lumber, adds to the illiquidity, and you're attempting to force people out that can't get out in the first place. So the next thing the CME can do is, they had this advisory announcement last week, effective March 7th, and I'm not going to read this verbatim, but effective March 7th, we're going to see spot. So just so everybody understands, this is not an immediate thing. They have to announce something and give it 10 business days before they can implement this. So they announced this last week. 10 business days is March 7th. So we know come March 7th, March has no limit. It's a spot month. So the next month out would be May. It's going to have a $57 increase. So daily limits will expand out to $57 in May and beyond. If you lock limit up, down, then you get expanded limits out to $86. And so the rationale, like, how did they come up with $57?
Hang on for just a second, though, Greg. Yep. So currently it's at $30 and expands to $45.
Correct.
So the limit up or down is $30 and expanding to $45 on the second day of a limit. They're changing $30 to $57.
Correct.
And then the expanded is 50% more than that, which you said was $86. $86. Okay. Go ahead.
So the big thing, Mike, is that under its current form, and I'm going to jump forward to this next, and again, I don't know if you can read this.
Yeah, that's pretty skinny.
Yeah, so I'm going to read this, and I apologize for this being so small, but as it exists today, you have this semi-annual backward-looking adjustment to price limits. So it's not forward-looking, it's backward-looking. So when lumber goes from $500 up to $1,300, you still have limits in place today that reflect a much smaller number. So what the CME is doing with these $57 and $86 limits is that 57 basically represents a 5% move somewhere in this $1,200 to $1,300 price area. They're being forced to move the bands out to reflect a 5% move in lumber. So again, this takes effect on the 7th of March. The big difference between this, Mike, and what exists today is that this $57 limit going out to $86 can be triggered off of the front 2 months. So not only can May set the expansion of the trading limit, it's also July. The front 2 months can trigger that limit move. So
one or the other.
So one or the other.
If July locks in and May doesn't, it's still going to expand.
It's still going to expand. And to go back down, so let's say you expand to $86. to come back down to 57, both May and July would need to close less than that $86, one
Okay.
way or the other. So that's the big difference versus what exists today. And again, Mike, all this is just, look, the reality is lumber should have again, I think we talked about this last week. When you look at the grain markets, you look at equities, they have something called a circuit breaker in effect, where there's no fixed price limit any given day. It's percent based. So if grains are worth, if soybeans are worth $10 and tomorrow they're worth $15, you have a 5% price band in any given day. If you touch that 5% threshold, you stop trading for 10 minutes, you trigger the first circuit breaker, and then you expand out to 7.5% or 8% or 10%, whatever whatever they decide on. So that's how most of the other markets at the CME trade. This is what ultimately lumber needs to move to, especially with this volatility. But under its current form, it's backward looking. It's not forward looking, it's backward looking. And this is why they have to expand the limits.
I agree. And it's I think that little bit of a break, that 10-minute or 15-minute circuit breaker, it gives the participants in the market time to readjust their strategies or even pay attention to the market. Had they planned on not participating that day, the market moved to such a level, oh, I guess I do want to participate. Um, it just gives everybody a little more time.
Yeah, and so the other thing I'll say is that, again, these are the internal statistics within the CME that have been conveyed. Typically, markets should trade limit up or limit down. They should experience price moves 2 to 3% of the time. You can do back of the napkin math pretty quickly with lumber, and it's significantly greater than 2 or 3% of the time. So you've got to do something to stop the limit up, limit down moves, and that's ultimately what they're working toward. So this is the next immediate step for the CME. I will say that because of this, this is a giant red flag market from a regulatory standpoint within the CME, but also with the CFTC. So you've engaged the right people, the right decision makers, C-suite type people at the CME. So there are significant kind of revolutionary, as far as lumber is concerned, pieces, parts in the works as far as reinventing this contract that I think happens sooner rather than later, because they know that under its current format, to implement any significant permanent changes, you would have to wait until you had a contract that didn't have any open interests. So, right now you're talking January lumber. You can't wait a year to change this contract. So there are significant changes coming down the pike for lumber. I'm not going to speculate on what they are. I want to see, what the CME is conveyed versus what they actually agree upon. But, the reality is this will be a smaller contract, whether it's truck based or it's half the contract base, but you're going to have a mini version of this contract. And the easiest thing for them to do to implement immediate changes and immediate, I'm talking 8 weeks, 10 weeks versus a year, you would just merge this existing contract into a new contract. That's kind of what's on the table right now. And that's the logical thing to do, where, we've tried to reinvent the wheel with this existing contract. It hasn't worked. It hasn't worked fast enough. So, let's create a new contract to deal with this immediately. And I think that's kind of the next bigger step the CME is looking at.
That's great, because now more than ever is the need for risk management tools, and
Yeah,
as
yeah.
the market's proving. So excellent. That's we'll keep we'll rely on you, Greg, to let us know what's going on.
Yeah, and again, as soon as
Really appreciate it.
they convey the information, actions speak louder than words, and that's why I don't want to. I want to see the actual, notice the service advisory on what they're going to do, and it is going to happen because you've engaged the right people that are going to make it happen now at the CME. Unfortunately, things don't change when things are going well. They change when things aren't going well. And like we've said before, Mike, this contract has exposed every possible flaw. The price swings, the volatility has exposed every flaw imaginable in this contract. So it's going to be dealt with sooner rather than later here.
Excellent, excellent. All right, well, let's. There's a lot going on in the world.
Yeah.
Let's talk about it, and let's see what you think out there.
So, we always start with this, and again, I'm not going to dwell on this. Obviously, equities have topped out for the time being. Lumber attempted to take out its high last week, got up to 1336, just missed the contract high of 1338.20. You're obviously getting some extraneous pressures from geopolitical events. The Ukraine Russian event is impacting all markets, including lumber. The other thing I'll point out on this chart, and I'm going to jump to a crude chart here, but 10-year notes did spike up to 2.04% last week. They're currently in the 1.95 area. And so we'll jump forward here. And Mike, stop at any point. But here's front month WTI crude, West Texas Intermediate crude. This is U.S. crude oil. And from its low back in December, this is well in advance of what's going on with Russia and the Ukraine. We bottomed out beginning of December, believe it or not, in the $62 area. We traded up to $96 in front month crude last night. So you've had a 54% increase in crude oil. Now, a big chunk of this is, Russia, Ukrainian related, but, I'm going to jump forward to the next chart here. Here's the crude oil structure. This is front month March crude, April, May, June, December of this year. Here's your backwardation structure in crude oil. Okay, just like lumber, other commodities have this contango or backwardation structure. Crude oil is the ultimate example outside of lumber right now of there is a perceived shortage. So whether it's supply or demand driven, but you look at everybody wants front month crude versus stair stepping down along the price curve here. I think the big difference in looking at something like crude oil, Mike, versus lumber, is this demand driven? Is this supply constraint driven? Is this a combination of the two? At the very least, we can say, given, and again, I don't want to get political here, but there is less crude oil in the pipeline, whether you're talking in the United States or globally, that's impacting an increase in demand coming out of the pandemic. And we have this backwardation structure in place now where, this tells you there's a shortage of energies, there's a shortage of crude oil, and again, it's up to the individual trader to extrapolate. Is this geopolitical? Is this supply constraint? Is this demand driven? But, there are other markets, other physical commodities that mimic lumber, and crude oil, the energy markets, heating oil, RBOB are all the other examples of what's going on when you get a backwardation structure in play or an inverted structure in play.
Well, higher prices bring on more supply. There's no doubt.
Yeah, yep. And so we jump forward back to lumber now. Again, here is continuation chart. Again, I'm going to jump forward. I'll come back to these charts in a second here, Mike. Here's March. And so you can see, oops, what did I do? Oh, sorry. Here we go. Here's March. You can see we just missed taking out the high here at 1338.20. We got up to 1336 right here. So from a technical standpoint, okay, here's the 9-day moving average. This is this upsloping blue line. This blue bar here, the gap high is a 1246. So lumber's kind of hemmed in this 1338 area to 1246. If you start to get consecutive daily closes underneath here, it opens up a much more severe pullback. You could trade into the 1175 to 1150 area for starters. Obviously, if you break out above 1338, then technically that's going to open up this 1375 to 1400 area for starters. And we know that, I'm going to jump back here on this continuation chart. This gap is a 1540. This gap or this bar high right here is a 1514. So the thinking is if you can get above the recent highs, then you surge ahead into this 1375, 1400 area for starters. If you fail, then you could have a 38, 50, 62% retracement from the recent lows. So again, the volatility in lumber is here. It's not going to go away, and you could have some pretty extreme moves in both directions as a result.
Yeah, that's when I look at that chart, it double tops seems to be what it's kind of forming right now.
Yeah.
Is a strong chart formation, very strong. Um, but when it's violated, that tells you that the move is extremely strong going up.
Yeah, and we'll jump into it with open interest, but I think one of the big issues is you're seeing an open interest build in the back months, primarily in May. You're seeing it in July, September, November, where March obviously is this liquidating contract now. So it's very difficult to, you see July on the board right now is limit down. May last trade is down 1780. March is only down $5. March is functioning more as its relationship to cash is getting closer and closer as you get closer to the spot month. But the inability to lock these back months limit up or limit down on a regular basis relative to March, you're putting liquidity back into these back months. And when liquidity flows into these back months, it makes it more difficult to lock this front month, which should be the driving force in lumber. Or, at least that's my interpretation anyway. So, seasonally, I'll run through these really quick, Mike. Here's a cash chart based upon a 3-year, 5-year average versus last year. So the red line is this year. A year ago, the black line is 2021. You can see seasonally, we have this topping out period. Don't fall in love with your longs into Valentine's Day, where you get this seasonal pullback into the end of March, beginning of April. And then, the last 3 years, 5 years, um, you basically have this peaking out into May expiration, similar to last year. Same pattern in futures here. So we'll see, do we mimic this pullback here over the next couple of weeks? And then do we have one final surge into April, May? Again, I think it's important to look at the seasonality of how lumber has traded both cash and futures here.
Yeah, that is a really amazing chart where May ends up being the high point
Yeah,
for
yeah. I mean, this is,
last,
if you were to go back and
last
look
three
at a
years.
10-year or 15 or 20, you've kind of pushed out when we seasonally top out. You've pushed it, typically it's into this February, March period. As of late, it's been pushed further and further. And you can make the case, is this more because of transportation, logistical issues, of that this gets delayed because people can't get, you can't get the wood into the ultimate end user's hands until later now because of, again, the rail car issues, trucking issues that are in play right now. Here's kind of the basis. We're currently in this $55 area. This was as of, right now it would be somewhere closer to 60, meaning futures is at a $60 discount to cash, or cash is at a $55, $60 premium to front month futures. And then as you jump into, here's the different species. You can see how everything is still extremely close when you look at a 2x4 comparison between spruce, eastern spruce, Doug fir, hem fir, southern yellow pine. Everything is clustered together where there's nothing overly obvious as far as species substitution. Nothing jumps out one way or the other here.
Got it. Got it. Yep. That is kind of interesting. Okay.
We went over the March chart. Here is your basis. A week ago, we were pretty much even money. Fast forward to this week. Again, you've got cash minus futures. So future or cash is at a $55 premium. Sawmills this morning were in this 1330 to 1350 area. And March right now is traded as low as 1247 today. It's 1264.90 last. So, at the very least, if you need the wood and want to sit there and look to EFP or potentially take delivery, I'd rather be buying March than buying sawmills at 1330, especially it being the 22nd of February here. You're pretty much talking the same wood at this point from where their order files are.
Yep. This is the tricky time of the year where that basis becomes extremely volatile for sure.
Yeah, yeah. So jump forward. Here's the May chart. Again, your double top formation.
Now there
Fast forward.
we did
I'm
take
sorry,
off
Mike. Go ahead.
we did take out the high in that chart though.
Yeah, you did. Sorry. Yeah, you did take out the high. That's absolutely correct. And if you were to look at the July, you did something similar. And you'll see this in the spread charts as well. So May basis, a week ago, May was trading $69 under physical cash. Fast forward today, you're at a $151 discount to where cash is. And again, if you're a forward curve person, I'd rather be wrong buying my May coverage at 1157 than buying cash and storing it at 1330. And again, that doesn't mean it can't go lower, but the curve is at least telling you the further out you go. Here's July, 152 a week ago. You're 247. So May today is 1157. July today is 1047. September is 980. Again, this is telling you, okay, we have a shortage of physical cash today, but as you stair step down the price curve, well, there's going to be cash at cheaper numbers because it exists today in the futures market. So again, if you need to own something, you want to lock something in, then at least you have the opportunity to do it in the back months at significant discounts to where cash is trading.
Got it. Yeah, let's take a look at the open interest and commitment of traders because I got an idea there.
So here's your open interest. A week ago, we were 25.74. March, again, is a liquidating contract, 11.21. May was 8.93. Fast forward, March is now down to 9.71. May is officially your front month with the build increase in open interest relative to March. Open interest 27.40. So amazingly,
How
we're
much is
building open interest and we're building it in the back months. So this is kind of unique this go around versus the previous expirations where we would kind of sorry here, I keep hitting the wrong button. Basically the last couple of expirations as March would liquidate, you really wouldn't see this one-to-one build transfer into the back months. So open interest would kind of stumble around. Now you're still absorbing the March loss of March open interest, but you're seeing a build in these back months, which is a positive thing. People see this as a buy opportunity, sell opportunity. There's definitely more comfort in May and beyond, which is a positive thing for total open interest.
All right, and then the commitment of traders. What are we seeing there?
Yeah, CFTC numbers are interesting to say the least. You saw both a build with commercial longs and shorts. If you look at the managed money, the commodity fund component, kind of love this punishment here. We saw this liquidate from 700, down into the 350, 366 area. Well, the funds are back in chasing the momentum here where they re-added 91 contracts to the long side. The other one that jumps out is the non-reportable. You've had almost a $250 swing from longs liquidating to shorts. So again, I call this the first in, first out, or I'm sorry, last in, first out crowd. This is typically tip of the spear margin calls right here. And okay, the market conceivably topped out. You made a double top. So you had long liquidation as a result, and then you had momentum trading now of guys chasing the momentum, especially in those back months, May and beyond, trying to chase that lower right now.
Well, and then the thing I see these the funds that are long have an excellent opportunity to roll that long in for a profit. So
Yep.
they're long
Yep.
March, and then they sell that March and they buy a July, and all of a sudden they're picking up $200 some dollars a thousand.
Yeah, and so Mike, I think that's a great point. When you look at the price structure, if you're long March, you have a luxury of rolling at a significant discount into May and or July. If you're short March, you've got to give up $100+ to go into March. You've got to give up close to $200+ to go in July. So, I've had more confidence in the last 2 or 3 rolls than I have in this March, May. And I'm going to backtrack here and just go, here's March, May current, uh, you know, by historical standards, it's $105. It's still substantially wide. And if we were a believer in the last three expirations, then this would collapse in where, when you look at Sep Nov, Nov Jan, Jan March, all those spreads collapsed in dramatically and went to even money to a discount. But I personally don't have that comfort level to say that this spread is going to be a collapsing structure, especially based upon the underlying strength in cash and the fact that March is a discount to March is a discount to cash. It becomes for me anyway, it becomes more difficult to say that this spread has to collapse in. So if I jump forward, here's that March May from a year ago. You had the ultimate bull market structure a year ago. So this spread went from 70 over. You can see this is kind of end of February. It traded to 160 over. It collapsed into 50, 60 as you had long fund rolling, and then it went back out to 170. I'm just wondering with March, May this year, could you mimic this pattern versus here's Jan, March? This is the last expiration where the spread structure just collapsed and you had the front month collapse under March. And there just wasn't a lot of interest to take Jan relative to where cash was trading at this point. So it just adds to, for me anyway, it just adds more to the confusion standpoint of where's perceived value. And if you need to buy physical cash today, again, mills, you're not going to buy physical cash in the secondaries at the mill level sub 1330 right now. So March becomes this buy opportunity. The back months become this buy opportunity if you need to get coverage relative to where cash is trading today.
Yep, I think that's great. Well, we're going to wrap it up here because you're getting to the end of your time. My takeaways are that we're really at an inflection point. I think the market's going to have the room with the new limits to be volatile when we get into March. So I think we could rapidly move away from the level we're at. And it could be up or down.
Yeah, I agree, Mike. I think this is, to sum it up on my end anyway, I think this is less to do with price and all about the timing. And from a timing standpoint, when does rail, when does transportation, logistics issues improve? When do they normalize? And to me, that's much more important than the actual price being a predictor. This is going to be more about the timing than anything else.
Exactly. All right. Hey, thanks, Greg. We'll check in next Tuesday. I'd love to hear some reports from you about EFP activity. I think we have correctly said it's probably going to be robust. If the structure stays the same, where cash is running a significant premium to the futures.
Yeah, definitely, Mike. I appreciate it. And if anybody has any questions, I know we didn't do this live today, but if there's any questions, by all means, please reach out to Mike or myself, and we'll be more than happy to answer them and bring them up. If anybody wants to see something next week, then by all means, bring that up as well.
All right, sounds good. See everybody next week, Tuesday on the 1st of March.
Thank you so much, Mike. Take care.